Hello dear traders, welcome. I thought I'd make this short video because someone asked the other day in the Discord group what the difference is between Forex pairs and the metals and cryptocurrencies. And to make a long story short, to come straight to the point, as you know from watching everything we have been doing, when it comes to Forex, no matter whether we're talking about the major pairs such as Euro Dollar, Aussie, Kiwi, Cable, and so on, or about the minor pairs, the market causality is very, very dominant. As you can see, maybe 5 to 10% of the price moves are determined by any economic fundamentals, such as economic news announcements, unscheduled comments, Federal Reserve Bank comments, and so on. Like you may have a move in one direction, a stop hunt, and then, depending on what the market causality shows, it may completely take back that move. Now, when it comes to metals, there we go, typo, such as gold and silver, which is included in the MK web, the impact of fundamental economics is higher. Maybe even up to 30% in certain periods, yes. That means the dumb money tolerance is higher. Sometimes the dumb money is allowed to get into profit significantly more as compared to Forex, yes. Where the dumb money tolerance, generally speaking, is very low. There are only phases where sometimes it gets higher, for example, after massive stop hunts and squeeze moves. When it comes to crypto, it's even more extreme, okay, because obviously most market participants do not really short sell crypto. Yes? Let's go to real life examples. So for example, here you see that longies buy more, and then the smart money algos push Bitcoin down against them significantly, for sure. However, sometimes it does happen that after this has been completed, some longies are in the market and the price goes into an uptrend. Yes. Whereas in Forex, it's really not like that. In Forex, it's like very, very precise in that sense. Now, if we look at gold in a longer time frame, you will see, especially if you look at the squeeze indicator, look, as soon as there's a squeeze, like short is selling, boom, it does a significant up move. If a long is buying and expanding, boom, there's a down move. So it's the same like in Forex. However, there are periods in between, like here, where it's a bit changey, and the market is a little bit more empty, and there's a range, and of course they go down against the longies eventually, but it can be slower as compared to, let's say, Euro Dollar, for example, where as soon as some longies come in, they would try to get them into loss. But overall, you still see that the causality works very well for the metals. That's why we have included them in the MK web. Let's look at silver as well in a longer time frame. Here the same. You see longies come in, they go down against them. Longies come in and build up, they go down against them. Here there was a period of consolidation, but then at some point, when they took the high, longies came in and they went down against them in the short term. So it also works pretty well, like in Forex. However, again, the dumb money tolerance can be a little bit higher sometimes. Yes. Like even a down move against the longies, if some shorties are lucky, so to speak, and they also sold in the right moment without knowing what's going on, they will be included in the tolerance and they can be allowed to win. But in this case, you see that they were expanding longies, which means the tolerance towards dumb money longies is very low, so the price goes down against them quickly, but the tolerance against the dumb money shorties is high. It's more important for the smart money algos to go after the dumb money buyers by pushing the market down, and in this process, since they also have an objective like long-term stops, LTS, and so on, in that process, some lucky shorties can also be led into profit. So in this mode here, the longies are the priority. The smart money algos want to kill the dumb money buyers. Okay, so in that process, the little dumb money sellers can be lucky and get into profit. But since they're blind and they don't see any of that, the next time the same chart pattern happens, the outcome will be completely reversed because the money is placed in the opposite direction. You see, it all comes down to the causality. No matter how we play it, it comes down to causality, really. Yeah. So please keep that in mind. These are the different groups we include in the MK Web. So in a broad sense, we have all kinds of currencies, whether it's a cryptocurrency or old school metal currency, all the major and minor Forex currencies. So we cover all the currencies in the world, but excluding like the very minor exotic pairs. We are focused on the main pairs, but you can really see this tendency clearly. Is like when it comes to the main pairs, let's look at euro dollar, for example. Let's look at Aussie. Yeah, it's clear what's going on. Shorties are coming in, boom, big up move. Longies are coming in, big down move. Okay, always look at the squeeze indicator. Today with some maintenance on the longer time frames, but this one is still a very clear reality. Yeah. Look at euro dollar day chart. We see the historic bars here. Longies kept on buying the dips, so the price goes down. Shorties kept on selling the highs, and the price goes up and kills them. Those longies, boom, got pushed into drawdown. Those shorties, boom, got pushed into drawdown. Yeah. This is how Forex works. They want to take the stops subject to their money positions, subject to what's going on overall in the market. And we have really to the T defined all those scenarios, which can also be found in the video course. And once you watch the MK Web, these principles become very clear. Alright, I'll leave it there. Let's keep this one short. Lots of love, happy trading.